Hi, I'm Eric Rodriguez, founder of WealthBuilders LLC. In today's video, we're going to walk through a real life client scenario that demonstrates how I help clients optimize their $5 million plus portfolios. We'll break down the current holdings, dive into some key areas that could be improved, and I'll walk you through how I've used my knowledge and my technology and my resources to help them plan for their future, run a detailed analysis, and really show them how we can optimize their portfolio so that they can achieve their retirement goals. Now, I'm going to share my screen here and show you what their scenario looks like so you have an idea of their goals, their overall wealth, etc. So first things first, we have Dan G and Sarah M. We've changed their names for privacy, but what they have here is they have a net worth of a little over $7.8 million with about $267,000 in the bank, another $5.2 million in their investment portfolios, and that's split across taxable, tax deferred, and a couple of Roth accounts. And then they have their property that's worth $2.5 million. That's pretty much paid off. They owe about $173 on it. Then to give you a good sense of what their goals are, so Dan and Sarah, they want to retire both at 65. They're both currently in their early 60s. They have a retirement expense goal. They want to be able to spend $12,000 a month. They want to be able to plan for healthcare and retirement, long-term care costs. They have a liquidity goal that they always want to have a cash reserve of about $50,000. They also have a couple different vacation goals. They want to be able to do international travel every 3 months, spending about $20,000. They also want domestic travel quarterly with about $10,000. And they also have a goal to purchase a Sprinter van. They have a goal to travel around the country and visit every national park. And rough estimates for a Sprinter van is about $140,000. They currently also have a home improvement goal that's going to cost roughly about $250,000. So this is their general situation. And what I'm about to show you is their current portfolio. And the next slide I'm going to share with you is pretty busy, but I just want to give you a sense of what we're working with here. So before I show you the analysis in the report, I want to walk you through what we call the overlap analysis. So I had my team at one of the local asset managers that I use, and what they ran is they ran an overlap analysis. And so what we're seeing here is we're obviously seeing a lot of different numbers, a lot of red, and this matrix. And what we're seeing is on the two axes on the top is what they currently own, and on the left is what they also own and what the overlap is. So for instance, if we take this Fidelity Purity Fund and we see that they have about 50.84% of exposure already in this Vanguard 1000 ETF. So this is interesting. So when we ran this analysis, what we saw across multiple different funds, as you can see here, is a huge overlap. So for example, they're paying 48 basis points in this Fidelity Puritan Fund, but they're already 50.84% of this fund is already exposed to the Vanguard Russell 1000 ETF at only 7 basis points. So this is a perfect example of you have a duplicate fund, you are overpaying 48 bips versus 7 bips. You're overpaying to ultimately get the same exposure. So when we looked at this analysis, we saw a bunch of different types of funds. We saw Class A funds, we saw active managed funds, we saw index funds, we saw target date funds, we saw bond funds. There was just a lot going on here. But as you can see, when we look at the overall portfolio, we are seeing a significant amount of overlap, which is eroding their portfolio, which is not the most efficient way to invest. And if they want to reach their retirement goals, we have to make some adjustments. Also, this is a very aggressive portfolio. This is a portfolio that's very heavy on equities. And this client also will need at least 20% of bonds to prepare for down years and to have that conservative bucket to pull from when they actually do retire. Now, one of the things that we also did is we ran an analysis. So one of the asset management firms I use, Dimensional Fund Advisors, what we did is we broke down their current portfolio and we compared it just to what a traditional 80-20 model could look like. So 80% of their money in equities and stocks, 20% in bonds. And what we found here was some staggering information. So when we look at the current portfolio, we could see here that this current client is exposed to almost 80% of US equities when they should be more roughly around 57, 58%. They also have a shortage of international equities when we should probably be looking at more at 15-ish percent. Not much exposure to emerging markets. Would love to get that up to like 6.45. And then as I mentioned, not much fixed income, only 3.85% of fixed income. They should be more like 20 given their risk tolerance, their risk capacity, and also what they need to have a sustainable retirement. So these were some very interesting metrics that we found. And also, as I mentioned in previous videos, the lack of international and emerging market exposure can really impact your performance over time. As I mentioned in one of my last videos, we don't want so much concentration or have a US bias because we want to be able to capture gains wherever they are. We have no idea which country is going to be performing. For example, this year, we've had international and emerging markets dramatically outperform US markets because of the self-inflicted tariffs that have been going on. But we definitely don't want to have too much in the States because, as I mentioned in the last video, we might potentially have the lost decade where in 2000 to 2010, the stock market returned zero. It was flat here in America, whereas global markets and global bond markets, well over 6%. So we want to be mindful of that, especially as you're going into retirement. Now, some other key considerations here when we're looking at the analysis was the amount of holdings the client had. I mean, we just saw this broad array of different types of managers. And some might argue, oh, that's great. You know, it's very, very well diversified. And yes, that might be true. You know, we have a really diversified portfolio of ETFs, of mutual funds and different growths and growth funds and active management funds and index funds. That could be true. But also what we found here is there's no strategy involved. There's absolutely no strategy with this portfolio. And when we go heavy into the detail of this portfolio, here's a couple other things that we uncovered. So when it comes to different sectors, what we saw is a pretty heavy tilt on, tech, on healthcare, communication services, and when we look at the overall portfolio, what we're looking at too is just a lot of large cap growth. And again, remember, a large cap company, that is a company that has a market cap of over $10 billion. So Googles of the world, the Metas, Nvidias, etc. These are all companies that have huge market caps. When you have too much money in large cap, you're potentially not earning as much as you probably could if you had a portfolio that was tilted more towards that evidence-based methodology, having more small cap stocks, having more value companies that have good profitability and global exposure. Now, when we also looked at this as well too, we saw, again, a huge opportunity to diversify. So in the current allocation, as I mentioned, 93% of this portfolio is in the United States, where we should probably dial it back, maybe only have 72%, and have the rest of the percentages spread out between international and emerging markets like Japan, the UK, China, Canada, India, Germany, Switzerland, France, Taiwan, and potentially some other opportunities. So we want the more global exposure, as I've mentioned here in previous videos and also in this video. And also another key component, which is very common when I see clients that have been managing their own investments for years, And just to be clear too, this client has multiple different IRAs, multiple different 401ks, multiple different taxable accounts. There was no structure, there's no plan. They've been very good at saving and very good at being frugal and really just having this intentional behavior around trying to save and spend wisely. They've done a fantastic job. But when it came to the actual characteristics of the portfolio, we see a lot of discrepancies here. Going back to some more characteristics. So when we look at their equities, I thought this was staggering. So this portfolio, again, really heavy in large cap stocks, very heavy in equities in general. The current portfolio only holds 6,700 companies essentially. And the portfolio that we'd probably recommend or close to recommending would have exposure to over 15,000 publicly traded companies across the world. So again, we believe, and I believe in owning the market so that you can capture returns wherever they are in the world. It can be in Germany, it can be in Japan, it could be China, it could be Brazil, it could be Russia, it could be India, it could be China, it could be the UK, you name it. We have no idea which is going to provide the highest returns. And we want to put ourselves in a position to own everything, and not huge percentages, but we want to be able to capture these premiums, capture these gains whenever they happen. That was on the equity side. When we go to the fixed income side now, not to make you dizzy here, but here's some characteristics here. So with the current portfolio, 28,000 holdings, 28,000 holdings. My mind was blown. This is way too much. We're paying way too much in fees. We probably have so much overlap. We're really looking only like 642 holdings here on the fixed income side. We only need about 642 there. And given their goals and their overall wealth plan, because you want to integrate your investments with your plan, we want an average maturity and duration to be pretty similar. So for example, we want their average duration, we want it to be around 5 to 7 years. So in this instance, with the portfolio that we're recommending, roughly 6.4 is the average duration, meaning that's when the bonds turn over. So if you have a goal of using this money in 5 years, 6 years, 7 years, then this is perfect. It was very difficult to figure this out with their current portfolio because they had so many holdings. The weighted average maturity and the weighted average effective duration were all over the place. Some were 30 years, some were 5 years, some were 7 years, some were 10 years, some were 15 years, some were 20 years. There was really just no plan. There was no intentionality around how the portfolio is invested. So as we wrap up, I want to share just one more quick thing too when it comes to their fixed income. So given that they will need fixed income, given that they want to retire, we want to also have exposure, as I mentioned, to different currencies. And this is for many different reasons, but it's more a risk management technique and an ability to get premiums and take advantage of flexibility on the daily trading when we see opportunities with currencies. So we would have about 58.4% fixed income allocation allocated to the US dollar, but then we would have about 17.37 in euros, and then the rest of it spread across Japanese yen, Canadian dollar, Australian dollar, British pound, New Zealand dollar, etc. Again, because we want diversification, we want exposure, and because we have an evidence-based approach that is flexible, we have the ability to capture opportunities when they come up. So again, it's not just about stocks, it's also about fixed income as well. We want to have a strategy so that we can put ourselves in a great position to win financially. So breaking this down on what we saw. So as I mentioned, we saw a lot of overlap and duplicate holdings. Sometimes investors unknowingly hold multiple positions in the same industry or similar companies, which can increase their risk and decrease diversification. We saw some really high fees as well. One of the things that we saw is we saw fees that were on the high end of over 58% on average, whereas the current portfolio fees would be roughly around 20 basis points. That's a pretty significant pop. When we're looking long term, 20, 30 years, that's upwards of $300,000 to $500,000 in additional fees that don't have to be paid. So we saw a lot of incremental fees that did not have to be captured. We saw investment styles and sectors that didn't really match their goals or risk tolerance. We also saw funds in here that have a lot of high turnover, meaning that's a higher capital gains tax that they'll have to pay in their taxable accounts, which is the last thing you want if you're nearing retirement or you're in retirement, right? So we're gonna wanna adjust those as well. So again, one of the things that we'll do, we're gonna review the portfolio for overlap and duplicate holdings. We're gonna make sure that we put them in low cost funds, low cost ETFs and funds. We're gonna make sure we review the investment style to make sure it's aligned with their financial plan and their risk tolerance. And again, we're going to review the sectors, make sure that the portfolio is properly balanced to match their investment strategy. We're not going to put them in investments that have super high turnover. We believe in focusing on tax efficient investments and reducing the unnecessary buys and sells. So that's just a quick look at what we're doing to help this client with the $5 million portfolio to help them optimize it for better growth, tax efficiency, and risk management. So if you found this video helpful, I'd love for you to hit that like button and subscribe to the channel. It really helps me get this content to more people who need to hear this information. And hey, if you know someone who's in a similar situation and could benefit from this, don't hesitate to share this video with them. Remember, retirement is about more than just saving. It's about optimizing the resources you already have. So if you're looking to make sure your portfolio is working for you, just like I did for this client, feel free to reach out as well and go to the website, WealthBuilders.com. I'm here to help you retire on your terms and make sure you're on track to live the life you want. So thanks for watching, and I'll see you in the next video. Once again, it's Eric Rodriguez here. If you're looking to get help securing your financial future and you're serious about implementing a wealth plan for your specific situation, feel free to check out my website, WealthBLLC.com, to learn more about how I work with clients, how I help them align their resources with their values, and put together a comprehensive plan to help them retire on their terms.